I want you to look at something nobody else is showing you right now. While every finance channel is covering the flash crash that took silver from 83 to 74, something far more important just happened in China. The physical silver price in Chinese shops is still sitting at $90 per ounce. Not 83, not 74, 90. Let that sink in for a second. COMEX, the supposed global benchmark for silver pricing, just crashed by $9 in a single session. Meanwhile, in Shanghai, in the coin shops of Beijing, in the wholesale warehouses where actual metal changes hands, the price didn't budge. It held at 90. This $16 gap between physical reality and paper fiction is the most important signal in commodity markets right now. And in this analysis, we're going to show you exactly why this gap didn't close when it was supposed to, why the manipulation attempt failed, and what this means for anyone holding silver heading into January. Because what you just witnessed wasn't a market correction. It was a failed suppression operation. And the evidence is written in that $16 spread. Let me show you what actually happened today, because the story you're hearing everywhere else is incomplete. Yes, COMEX silver flashed to 83.71, then crashed to 74. That part is true. But here's what they're not telling you. During that entire $9 crash, physical silver in China never moved below 90. I'm not speculating. We have the data. A channel called Fei Yen posted physical shop prices from China 2 hours ago. $90.25 per ounce. That was after COMEX had already crashed. The Shanghai Gold Exchange showed similar numbers. Physical delivery contracts were still settling in the high 80s, low 90s. So what does this mean? It means the crash you saw on your screen, the one that terrified retail investors and triggered stop losses across the Western world, was a paper event. It happened in the derivatives market, in the futures casino where contracts trade hands 99 times without anyone ever touching metal. But in the physical market, where factories need silver to build solar panels, where manufacturers need it for electronics, the price held firm. Now let's talk about why this is the most bullish signal possible. When COMEX crashes and physical doesn't follow, it tells you one thing: the paper price has lost control. Think about how commodity markets are supposed to work. If the global benchmark price drops $9, every dealer on Earth should lower their prices to match. Arbitrage should close the gap instantly. Traders should buy the cheap paper contracts, take delivery, ship the metal to China, and sell it for 90. That arbitrage should happen in minutes. But it didn't happen. The gap didn't close. It widened. Why? Because there's no metal available to deliver. The COMEX vaults are running so low on registered inventory that when traders try to take delivery, they get cash settled instead. They get paid off. The exchange says, "Sorry, we don't have your silver. Here's dollars. Go away." So the arbitrage breaks. The mechanism that's supposed to connect paper and physical stops working. And when that happens, you end up with two separate markets. A fake market trading at $78 on a screen in New York, and a real market trading at $90 in warehouses across Asia. Let me explain who got destroyed today and who made a fortune, because this wasn't random. This was surgical. When silver gapped open Sunday night at $80, a wave of retail traders rushed in. They saw the momentum. They wanted to catch the rocket. They used leverage, 10 times, 20 times, because they wanted to turn $1,000 into $10,000 overnight. The banks have algorithms that scan the order book. They know exactly where these leveraged traders put their stop-loss orders. Most people who bought at 80 put stops at 75. So here's what the banks did. They waited until Ghost Week, when liquidity was at its thinnest, when most institutional traders were off for the holidays. Then they dumped a massive block of futures contracts at the high. This pushed the price down to 79, then 78, then 77. As it approached 75, the stop losses started firing. Snap, snap, snap. Thousands of retail sell orders hit the market at once. This created a cascade, forced liquidations. The price plummeted to 74 purely because of algorithmic selling. And guess who was waiting at 74 with buy orders? The same banks that sold at 83. They sold high, forced you to sell low, then bought your position back at a discount. This is called a stop hunt. It's brutal. It's legal. And it happens every single time the market gets over-leveraged on one side. But here's the critical detail everyone is missing. While the Western retail traders were getting liquidated, while their accounts were getting margin called, and their positions were getting closed at losses, industrial buyers in China were celebrating. Imagine you're the procurement officer for a solar panel company. You need 50 tons of silver this quarter. You saw the price hit 83 this morning and you were panicking. Your budget was based on $70. Then you saw it crash to 74. Did you panic? No. You hit the buy button instantly. You secured 6-month forward contracts at 75. while retail traders were crying about their losses. This is why the price bounced so hard from 74 back to 78. Industrial demand stepped in. The smart money, the money that actually needs the metal for production, used the manipulation against the manipulators. They absorbed the paper selling and turned it into physical delivery requests. And when you request physical delivery from COMEX, you drain the registered inventory. You pull real metal out of the vault. This tightens the supply even further, which makes the next manipulation attempt even harder. Now let's talk about what this means for the chart. Technically, that candle is called a shooting star. It has a small body and a very long upper wick. The wick represents rejection. The market tried to go to 83, but sellers pushed it back. Textbooks will tell you a shooting star is bearish. It signals exhaustion. But context matters. A shooting star at the end of a long rally after months of gains, that's bearish. A shooting star at the beginning of a breakout during a holiday week with no volume, that's just a liquidity vacuum. It's noise. Here's what matters. Look at Friday's close. We closed at 71.91. Right now we're trading at 78.36. Despite the crash from the highs, we're still up nearly 10% from last week. If you ignore the wick, if you ignore the 83 flash, this is a massive green week. The trend is still intact. The breakout is still valid. The only thing that changed is the leverage got flushed. The weak hands got shaken out. And now the market can consolidate before the next leg higher. Let's zoom out and look at gold, because gold is the anchor. Gold is trading at $4,514. It barely moved today. It didn't flash crash, it didn't spike, it just sat there calmly at all-time highs. This tells us that the monetary crisis is still in play. Gold wouldn't be at 4,500 if the financial system was healthy. Gold at 4,500 means central banks are still printing, debt is still exploding, and trust in fiat currency is still collapsing. Silver is just the high beta little brother. It amplifies gold's move in both directions. Gold goes up 5%, silver goes up 15%. Gold drops 2%, silver drops 8%. This volatility is the price you pay for silver's leverage. If you want the gains, you have to stomach the swings. But as long as gold holds above 4,500, the floor under silver is rock solid. The macro trend hasn't changed. We're still in a monetary reset. We're still in a supply shortage. We're still heading toward triple-digit silver. Today was just a speed bump on the highway. Now here's the part that should terrify the banks. The physical disconnect is accelerating. 17 hours ago, I posted a video showing you the $90 China price versus the $75 COMEX price. That was a $15 gap. Since then, COMEX crashed to 74, trying to shake confidence, trying to close the gap. But China didn't follow. The gap widened to $16. Think about what that means. The banks threw everything they had at the market today. They burned through their ammunition. They triggered every stop loss. They created maximum fear. And the physical price didn't move. That tells you the shortage is so severe that even a $9 paper crash can't dislodge physical supply. The holders in China, the manufacturers, the stackers, they looked at the screen, saw 74, and said, no, our silver is worth 90, we're not selling. This is price discovery failing in real time. COMEX is supposed to be the price discovery mechanism for the global silver market, but when physical trades $16 higher than the benchmark is broken. It's irrelevant. It's a sideshow. Let me show you the historical parallel because we've seen this before. In 1980, during the Hunt brothers silver squeeze, the COMEX changed the rules mid-game. They implemented Silver Rule 7, which raised margin requirements and restricted buying. The price crashed from $50 to below 11. The Hunts were forced to liquidate. The shorts won. But here's the difference. In 1980, there was no physical shortage. The Hunts were trying to corner the market through speculation. They were buying futures, not draining vaults. Today, the shortage is real. It's structural. It's driven by solar panels, electric vehicles, AI data centers, industries that consume silver and never recycle it. The banks can raise margins all they want. They can crash the paper price all they want, but they cannot create silver out of thin air. And as long as physical buyers keep pulling metal out of the vaults, the end game is the same. The paper system breaks. The price gaps up to match physical reality, and everyone holding paper gets settled in cash at a fraction of the real value. Now let's talk about what's coming in January, because the setup is perfect. The leverage flush we just saw cleared the decks. The weak hands are gone. The tourists who bought at 83 with 20 times leverage got wiped out. What's left? Strong hands, physical holders, industrial buyers, long-term investors. And here's the kicker. The pension funds we've been talking about, the ones preparing to allocate billions into silver in January, they didn't want to buy at 83. They thought it was too extended. But at 78, that's a discount. The crash just created a better entry point for the largest pools of capital in the world. When a pension fund manager looks at today's action, he doesn't see a failed rally. He sees that silver touched 83 and is now available for 78. He just saved $5 an ounce on a billion-dollar position. That's a win. So, ironically, the manipulation designed to kill the rally actually made the rally more attractive to the smart money. Let me give you the numbers on the monthly close because this is critical. Today is December 29th. We have 2 trading days left in the year. Wednesday, December 31st is the final bell. For technical analysts, the monthly candle is everything. If silver closes the month above 75, it will be the highest monthly close in history. It will print a massive green candle on the yearly chart that engulfs the last 10 years of consolidation. This signal is so powerful that it overrides daily volatility. It tells trend-following algorithms that a new secular bull market has begun. Secular bull markets last 10, 15 years. They don't care about a $9 dip on a Monday. Right now, trading at 78.36, we have a $3 buffer above 75. The bulls are winning. They just need to hold the line for 48 hours. And with gold sitting at 4,500, with China holding at 90, the momentum is on our side. Here's what the banks are facing right now. They smashed the price today. They cleared out the leveraged longs. But in doing so, they added to their own short positions. They sold more futures at 80, at 78, at 75. They dug the hole deeper. And every time they do this, they increase the explosive potential of the next rally. Because at some point, someone is going to demand delivery. A big industrial buyer, a sovereign wealth fund, a central bank is going to say, I want my 50 tons of silver, deliver it to my vault. And COMEX is going to have to scramble. They're going to offer cash settlement. They're going to raise margins again. They're going to delay delivery. And when word gets out that COMEX can't deliver physical metal, the price will gap. Not to 85, not to 90. It'll gap to 100, 120, maybe higher. Because the market will realize the emperor has no close. The paper contracts are worthless. Only physical silver has value. Now let's address the fear. I know some of you are looking at that $9 crash and thinking, maybe I should take profits. Maybe this is the top. Let me give you the antidote to that fear. Go back and look at what silver did in 2011. From January to April, silver went from $27 to $49. It nearly doubled. Then in May, it crashed from $49 to $33 in 4 days. That's a $16 crash. Retail panicked. They sold. The media declared the silver bubble dead. And what happened next? Silver chopped around for a few months, then made another run at 50. It didn't break out, but it tried. The point is, the crash didn't end the bull market. It paused it. And this time, the fundamentals are 10 times stronger. In 2011, there was no supply deficit. Today, we're in year 5 of consecutive shortfalls. In 2011, there was no China export ban. Today, we have a policy-driven supply shock coming January 1st. In 2011, there was no semiconductor demand, no AI data centers, no electric vehicle boom. Today, industrial demand is structural and locked in for a decade. So if you're comparing today's move to 2011, you're missing the point. This time is different. This time, the shortage is real. Here's your action plan for the next 48 hours. First, do nothing. I'm serious. Do not panic sell. Do not revenge trade. Do not try to scalp the chop. The market is designed to shake you out right now. Liquidity is thin. Algorithms are painting weird candles. Spreads are wide. The best trade is no trade. Just hold. Second, if you have dry powder, if you have cash waiting on the sidelines, 78 is a gift. The market just handed you a $5 discount from the high. Use it. Buy physical if you can get it. Buy fully paid mining stocks if you want leverage. But do not use margin. Do not use options. The volatility is too high. You will get stopped out. Third, watch the 75 level. That's your line in the sand. As long as we stay above 75, the breakout is intact. If we dip there again, it's a buying opportunity. If we break below it on heavy volume, reassess. But right now, 75 is the fortress. It held at 74.47 today. It will hold again. Let me give you the mindset you need to survive January, because the volatility we saw today is going to look small compared to what's coming. When the pension funds start buying, when the industrial orders hit, when the January effect kicks in, we could see $10, $15 moves in a single day. Both directions. The market will whip. It will test your resolve. It will make you question everything. But here's the truth. If you believe the silver shortage is real, if you believe the monetary system is broken, if you believe solar panels and EVs need silver and there's not enough supply, then the only move is to hold. The volatility is the price of admission. It's the tax you pay for being early. The people who bought silver at $12 in 2020 went through this. They watched it crash to 18 in 2021. They held. Now they're up 500%. The people who bought gold at $200 in 2001 watched it drop to $250, then to $300, then back to $280. They held. 15 years later, gold hit 3,000. Patience beats panic every single time. Now let me tell you what the $16 gap really means for the future, because this is the final puzzle piece. When physical and paper prices diverge this severely, one of two things happens. Either the paper price gaps up to match physical, or the physical market stops using the paper price as a reference. Both outcomes are bullish for holders. If COMEX gaps up, your silver appreciates overnight. If the world stops using COMEX and starts settling at Shanghai prices, your silver appreciates overnight. There's no bearish scenario here. The divergence cannot persist forever. The market will resolve. And resolution means higher prices. The only question is timing. Does it happen in January, February, April? I don't know. Nobody knows. But the direction is locked. We're going to triple digits. The path might be volatile. There might be more crashes like today. But every crash will be bought. Every dip will be absorbed. Because the industrial bid is real. The shortage is real. And the fiat currency collapse is real. Here's my final message before we close out the year. If you held through today, you just proved you have what it takes. The $9 crash was designed to scare you. It was designed to make you think the rally was over. But you didn't sell. You're still here. You're still holding. That means you understand something most investors don't. You understand that volatility is not risk. Risk is being in cash when the dollar collapses. Risk is being in bonds when rates spike. Risk is being in stocks when the everything bubble pops. Volatility is just noise. It's the static between the signal. And the signal is clear. Silver is repricing. It's moving from commodity to monetary asset. It's moving from $30 to triple digits. The journey won't be smooth. There will be days like today. But every day like today clears out more weak hands and makes room for more strong hands. And strong hands are the ones who get rich. We have 2 days left in 2025. 2 days until the monthly candle closes. 2 days until the yearly candle prints. If we close above 75, and we will, it's a historic signal. It tells the world that silver is back. It tells the algorithms to buy. It tells the pension funds the entry is clear. And most importantly, it tells the banks that the game is over. They lost. The physical market has decoupled. The shortage has won. And in 2026, we're going to see the paper system break in real time. So hold your silver. Hold your mining stocks. Hold your conviction. Because what you just survived was the final test before the real rally begins. The $16 gap is the proof. China said 90. COMEX said 74. And the market is about to decide that China was right. This content is for educational and informational purposes only and does not constitute financial or investment advice. Always conduct your own research and consult a qualified financial advisor before making investment decisions.